We, the Center for Global Development, we're a group that try and see how we can make the international system that supports global development work more effectively.
How do we finance infrastructure in the poorest parts of the world? How do we increase productivity in agriculture? What kind of policy brings out the best outcomes?
What CGD is about is you can ask those difficult questions that people refuse to ask and actually find solutions.
We're thinking about how climate change will impact migration patterns, how that will in turn have impacts on people's health.
It's challenging to be able to align budget with ambitious programmatic goals, but it can be done.
If you can help to make things a little bit better, that's a good way to spend your time.
Welcome. I am Liliana Rojas Suarez, Director of the Latin American Initiative at the Center for Global Development. It is a real pleasure to moderate this conversation with four distinguished governors and deputy governors of central banks from Latin America. Leonardo Villar from Colombia, Stephanie Griffin-Jones from Chile, Jonathan Heath from Mexico, and Julio Velarde from Peru. Welcome to all of you, and thank you for participating in this panel. Before we start, let me tell the audience that we'll be glad to take your questions. Please send the questions and comments in the YouTube chat. Okay, so rather than starting, more presentations, and I say, why don't we just move ahead and start our conversation, because we have limited time and lots to talk. So on the first round of questions and discussions, why don't we talk about the uncertain global environment? Why don't we let's start by setting up the stage in which central bankers from Latin America operate, the state of the global economy. Right now, we're witnessing a mix of good and not so good news and some very large uncertainties. In my view, the best two pieces of news for 2024 are that inflation has come down significantly and the risk of a hard landing for the US, basically the combination of high inflation and recession, is not materializing. The not so good news is that global growth will remain low, partly, of course, because of the monetary adjustments, but also because of idiosyncratic factors in other places of the world, such as Europe and China. Two large and interrelated economic uncertainties are, first, the evolution of geopolitical problems with big risk of escalating in the Middle East, with the consequent economic effects on the price of oil and disruptions in the global supply chain. The second risk is the dynamics of inflation and the path of global interest rates. As we all know, in the last couple of months, inflation has ceased to decline in the US and has even slightly increased under some metrics. This is changing market expectations about the Fed's path of cuts in interest rates. As you know, at the beginning of the year, market participants were expecting 3 rate cuts by the Fed in 2024. Now, most market participants and commentators expect 2 or even only 1 cut. So, in this very uncertain context, let me first ask Governor Villar, Governor Heath, Deputy Governor Jones, and Governor Velarde, how he can join us. We are having some problems with connections. What are your views on major risks to inflation and growth in Latin America coming from the global economy? And do you agree with the view that interest rate cuts in the US will be slower, or do you expect large cuts in the Fed funds by 2024? So let's take 3 to 4 minutes of each of your participations. Why don't we start with Governor Villar?
Okay, thank you, Liliana. It's a pleasure to be here and be with Stephanie, Jonathan, and Julio. I would say that we are becoming used to uncertainty. Uncertainty has been the pattern of the last 5 years, at least, since the pandemic. And we are always facing new sets of issues in which uncertainty is huge. But from the point of view of the Colombian economy, I would say that the international financial conditions during the last year have been relatively helpful for Colombia. We have had a situation in which interest rates, long-term interest rates, have been going down in general, especially during 2023. Risk spreads for Colombia have gone down as well. Um, and more recently, we have had geopolitical tensions, which paradoxically have an additional positive impact on oil prices, which benefits Colombia. So this has implied that the Colombian peso have appreciated very significantly during the last year and a half. This is helping us with the reduction in inflation, but we of course are working with the uh, basic assumption of three uh, cuts in the interest rate in the US. So the uncertainty in that front may affect the the path of our interest rate reduction in the next few months.
Okay, thank you so much, Leonardo. Deputy Governor Heath.
Yes, I mean, I think Mexico is facing a very similar situation that we're observing in the U.S. Um, our inflation had been coming down, and I would say in a pretty good fashion. And then somewhere around October, after hitting 4.2, it's kind of ticked back up again. And in the last 5 months, we've seen kind of inflation in the range of 4.3, 4.5, but not really showing a more definite downward trend anymore. And the main reason is a very strong persistence in prices of services. Prices of merchandise seem to be still coming down, and I think the main thing is that basically we see that most of the pressures behind inflation in 2021 and 2022 were global. But starting in 2023, we saw a transition to much more domestic pressures. And because services are more non-tradables, and also there's a certain resetting process in terms of relative prices, right now we have to concentrate much more on services, break the persistence of services if we want to continue to see a downward trend in inflation. And we see that right now we're probably in the hardest part. It was relatively easy to go from our high of 8.7 to slightly above 4, but to go now below 4 and get nearer to our target of 3% is going to take a lot of effort.
Okay, but so in terms, you're talking about events in the US, but do you also perceive that some other global events could affect you? I mean, Mexico is quite involved in the global supply chain. Does problems in the Middle East or so would affect in any way?
These are always risks. There's no doubt about it. All the global pressures and any type of a situation that could happen, commodity prices going back up again. We have here locally a very serious drought, and maybe also agricultural prices worldwide are going to be very much affected. We have a huge connection in our food prices with all global pressures. So all of these things are definitely risks on the upside for our inflation outlook.
All right, thank you. Stephanie, Deputy Governor from the Central Bank of Chile, your views on the global economy.
Well, I'm delighted to be here. Thanks very much for the invitation, Liliana. I'm delighted to be with Leonardo and Jonathan. On the international side, we see the recent changes in activity as rather positive, especially in the US, because the projections that we had for 2024 for the US only in December of last year was only a growth of 0.6%. And now we're projecting 1.9% of growth for the US. And there is a talk, as Nuria Rubini put it, that it's not a discussion between hard landing or soft landing in the US, but no landing. So that seems to be good news for us, although we don't trade as much as we would like with the US. We see strong growth in consumption, and we see a labor market which has continued to grow in employment and a gradual increase of real wages. The rest of the world has far less good uh, performance, although some recent figures um, of high frequency that we look at look a bit more favorable. China, of course, still, who's a major trading partner for Chile, particularly for copper, it still has risks, important risks from its housing sector and, of course, of the balance sheets of local governments. But what is good, at least from a Chilean perspective, and possibly also other countries in the region like Peru, is that the most dynamic part of the Chinese economy, which of course has slowed down, this more dynamic part includes investment in renewable energy and in advanced technologies like electromobility of cars. And that is very intensive in copper and has a high demand for lithium. So that we're quite hopeful that this will help from the demand, for external demand for Chile. And of course, the European Union is not doing very well, particularly Germany. But as regards inflation, which is, I think, a concern, world inflation is going down, but as they call it in the US, inflation in the US is sticky. And we just had today this number, which came out 1 decimal point higher than expected, monthly inflation, 0.4 instead of 0.3. But that means, as you pointed out, Liliana, that it looks like there'll be at least not like the Fed had announced three occasions in which they would lower interest rates, but possibly two or even one. I think Goldman Sachs was projecting two, but this will be changing, and this will of course have an effect on all emerging economies, including our economies.
Thank you so much, Stephanie. Okay, why don't we move right on the center of our conversation, which is, of course, the effectiveness of monetary policies and the conquering of inflation. The central bank represented here have certainly done a great job in fighting inflation, and they have been praised by the markets, the multilateral organizations, on how Latin America have reacted, before the United States and all advanced economies in raising interest rates when the signs of persistent inflation were clearly there. But the dynamics of inflation have been quite different across countries. So Governor Villar, although declining, inflation in Colombia has remained stubbornly high, certainly higher than the other countries represented in this conversation. Inflation seems to be particularly sticky in the services sector, especially the rents component. What do you think explains this outcome? There seems to be an important role played by backward-looking indexation to the elevated inflation of 2023, again in the rent sector. What are your views on this, please?
Okay, Liliana, I think, well, first, Colombia has had several characteristics that imply that inflation has been more persistent than in other countries of the region. Among them, we have this persistence in the services sector, which I think has to do with partly with our history. We had stable high inflation, stable moderately high inflation during almost 40 years in the last century. And that created in Colombia lots of mechanisms of indexation. But one of them is the mechanism by which the minimum wage is set in Colombia every year based on the observed past inflation. And what has happened during the last 3 years is that both the previous government and the current government have increased the minimum wage quite significantly above observed inflation. And that has created more persistence, more difficulties to reduce inflation, and makes it more costly to bring inflation down. In any case, I would say that the inflation is going down. The inflation was 13.3% 1 year ago. Today is 7.3%. So we have reduced inflation by 6 percentage points, which is perhaps the second largest reduction in inflation in Colombian history. The first one was in 1999, within a very dramatic recession that we had at that time. This time we had this type of a very strong reduction in inflation without a recession, which is a very positive result. And we expect to have additional reductions soon. So we would end up this year with inflation around 5.4%, which is more or less the consensus today, and to reach our target of 3% plus or minus 1 percentage point by mid 2025.
Yeah, let me go a little bit further on that. If this indexation mechanism, implicit in a way, right, because is in place, are you taking that into account when making your projections for the getting the target in 2025? Because it looks like the indexation is actually preventing the convergence towards the target.
Yes, we are taking that into account, and I think it's very important to see that we took that into account last year, and we were able to reduce inflation by 6 percentage points, despite the fact that the government at the beginning of last year of 2023 increased the minimum wage by 16%. And this year, they again increased the minimum wage by 12%. That, of course, makes it more costly to reduce inflation and more costly in terms of economic activity. But we are also having in mind that we have had to reduce inflation at the same time as we see a very sharp increase in domestic fuel prices. Fuel prices in Colombia, especially gasoline prices, have been frozen in 2021 and 2022. And during 2023, the government had to increase the gasoline prices by more than 50%, 50%,
Wow.
in order to reduce the fiscal deficit.
Wow.
And we had to reduce inflation despite that fact, which is a very important fact, and despite the indexation and those increases in the minimum wage, which is very important in Colombia. It's binding the minimum wage for many wages in the country, and for many tariffs and other prices in the country. So we of course have that in mind, and we are optimistic about the reduction we are already seeing, but also the one we will accomplish at the end of this year and in the first half of next year, so that we can get to the target by the second half of 2025.
Thanks so much. Very complex situation, certainly. Deputy Governor Griffith Jones, different situation here. The Chilean peso has depreciated significantly during the first quarter of this year, continuing with the trend observed in December 2023, following the beginning of the interest rate cuts by the central bank. Although the central bank has slowed down the pace of its easing cycle, are you concerned about the pass-through effects from the depreciation of the exchange rate to inflation? Some recent studies have estimated that there could be significant pass-through effects that actually take place with significant lags. Could the weakness of the currency pose an important risk to the process of disinflation in Chile?
Let me give you first the broader background, if I may. I mean, Chile was one of the first countries that started raising interest rates because inflation reached 14.1% in August of 2022, which was much higher than what it had been historical, because historically, for the last several decades, it had been around 3%, which is our target. And at the same time, there was a very large current account deficit, which bordered already 10% of GDP. And so this was due to an excess of demand caused mainly during the pandemic due to very large fiscal transfers, and also very large withdrawals of private pension funds. So, plus, of course, the cost pressures that came from the Russian invasion to Ukraine and so on. So, we raised interest rates a great deal from 4% to 11.25%. That is 725 basic points from January to October 22. And then, as soon as inflation started going down, we started lowering these interest rates. And now we've reached 6.5% in our recent meeting a few days ago. As we saw the data on inflation improve, because the last numbers for IPC inflation, March, show us that inflation with a new basket that has just been recently renewed, we have only inflation of 3.2%, which is what we are very near the target, although we expect it to go up a little bit during the year. And the other good thing, which I think is different from other Latin American countries, is that the expectation of inflation have been anchored already in different periods of time, already for several trimesters. So we have, quite a positive record on inflation, and that has allowed us to be proactive in lowering interest rates. But you're right that because our interest rates are now lower than other countries of the region, there have been some short-term flows which had entered Chile at the time that we were raising interest rates so much and had helped to appreciate the currency a lot, and are now have had some depreciative tendency. Although I must stress that in recent days, before the announcement of the US IPC, we had actually had quite an interesting appreciation of the peso. So that made it less worrying. We are projecting that the pass-through that we have of depreciation to inflation is lower than it has been in the past, because aggregate demand is still relatively weak. And so therefore, and companies have quite high margins of profit. So there is more space for them to absorb increases in cost, which wouldn't be just from the exchange rate, but they would also be from things like international prices of oil going up, which is good for Colombia, as Leonardo said, but it's not good for us because we import all the oil that we have.
Thank you so much. All right, let's move to Deputy Governor Heath. Again, different dynamics of inflation than the other countries. At its peak, inflation in Mexico was lower than other countries. When the inflation rate peak was lower than other countries in Latin America, Mexico and Peru, which unfortunately the governor had problems connecting and is not joining us this time. But Mexico and Peru had, among Latin American countries, the lowest peak of inflation. And inflation have already, of course, reduced significantly, getting close, but not quite yet there to the target band. So, what will it take to reach the last mile in inflation stabilization? And when do you anticipate to get normalization both in inflation and interest rates?
I think that there's one very obvious reason why we had a lower peak compared to other countries, and it's because the government set up a gasoline price policy to try and keep gasoline prices capped when around a certain range. So our gasoline prices did not go up in 2021, 22, 23, 24, but they didn't come back down either, obviously. So it helped us maybe achieve a lower peak, but at the same time, when other countries were seeing a faster downward trend in inflation after gasoline prices started coming down, we didn't have that advantage. However, I think that what we're looking at up until now is that the part of inflation that has definitely come down has been that of merchandise prices. And that is definitely due to the dissemination or the dissipation, of global pressures. And it happened, I would say, in almost most countries. We also had our inflation peaking somewhere in August, September of 22, and started seeing inflation coming down. And without a doubt, it was merchandise prices that were starting to come down. And obviously, we had a lot of help on the non-core part. However, those two things are not necessarily that related or that much of a consequence of monetary policy. The goods part, you could say it is. However, most of the downward pressures came from the stopping global pressures from causing upward movement in those prices. And the non-core doesn't respond much to monetary policy, so we can't really take much credit for that. Going forward, our problem is the same as in Colombia and other countries. It's the services part, which in theory is much more susceptible to the cyclical conditions of the economy. However, last year we had an economy that grew quite well, above 3%, very strong household consumption, and a very surprisingly growth in private investment. Private investment grew almost 20% last year, which was the highest growth we've seen in like 20, 25 years. So this has kept up kind of the dynamics, the demand pressures on in the economy, which is bringing down and breaking that persistence that we're looking in the services part very, very difficult. I would say a very important comment in terms of the effectiveness of monetary policy in Mexico is that we have a much lower financial deepening, and as a consequence, much lower credit penetration, not only compared to developed countries, but compared to our peers, compared to Colombia, to Peru, to Chile, to Brazil, which that means that the effectiveness of a lot of the monetary policy transmission mechanisms which go through the banking system are much less effective. In spite of the fact that we've had a relatively high monetary policy rate, and we've kept it there for about a year, credit in the banking system is still growing in real terms. Non-performing assets haven't really increased at all, haven't even budged. And we're looking at a lot of characteristics of the economy that should be responding to a very restrictive monetary policy stance, haven't quite really reacted yet. So that leaves us basically with two mechanisms, which is the exchange rate mechanism and expectations. However, the exchange rate mechanism, although it does feed into the expectations part, which that is good, by itself isn't really that important right now at this moment, because merchandise prices are definitely showing a very definite downward trend, and they're keeping coming down. Non-food merchandise prices are below 3% now, which is extremely good. Processed food prices have been coming down from a high of 14%, and they're the prices that the inflation that has come down the most, but they're still slightly above 5%. So we still need to see progress there. However, we're quite satisfied with the continuous downward trend that we're looking at. So our challenge right now to bring inflation down from our 4.4 where we are right now, and we seem to be kind of stuck there, to bring it down to our target, which is 3%. We don't have a target range. We have a very definite 3% target with a variability range from 2 to 4%, but that's not a tolerance range. So we want to bring inflation down to 3%, not just below 4. So we still have a ways to go. And the only way we can do that is to break the persistence on the services component of inflation. And to do that, we need to maintain a very restrictive monetary policy stance to break it. Much more restrictive than our peers, much more restrictive than other countries, because our monetary policy is less effective.
Yeah, yeah, yeah. As I was saying, the dynamics between countries is incredibly different. It's just amazing that the achievement that have been gotten by all the countries that we're discussing and most of Latin America, given that the characteristics of each country differ significantly. Talking about differences, let's talk about fiscal and monetary policy. We all know that policies work better when they complement each other. For example, if the central bank aims at decreasing interest rates, as that's the point right now, its work will be facilitated by the absence of fiscal deficits, which could be pushing for high interest rates, right? So, Governor Villar and Deputy Governor Heath, forecasts for the fiscal positions point to a deterioration of the fiscal balance in Colombia and Mexico. Relative to other inflationary targeters in Latin America, Colombia and Mexico face the largest MB spreads, right? For our audience, the cost of international financing, which clear affects financing costs for all the economy. In both countries, how serious is the risk of significant fiscal slippages to the capacity of the central bank to reduce interest rates? Governor Villar first, please.
Well, this is a very difficult question, but what I would say is that we had much higher deficit than other countries in 2022 and 2021, and we lost our investment grade in 2021. Since 2022, we have reduced our deficit. It was reduced significantly, partly in 2022 and again very significantly in 2023. There are some concerns about the prospect for this year, but the government has explicitly said that they will comply with the fiscal rule, which, because of the reduction in economic activity, the reduction in growth, they are allowed to have somewhat larger fiscal deficit this year than last year, and that will increase a little bit the debt over GDP ratio in 2024. Still, that will be consistent with the fiscal rule, and in that sense, this is acting in the direction of helping monetary policy in adjusting the economy. There are some concerns about whether the prospects for the fiscal accounts this year will be accomplished, but what I would say is that we are confident that the government will adjust whatever they need in order to comply with the fiscal rule. In that sense, we have fiscal policy working in the same direction, and we have had that during the last 2 years in the same direction of monetary policy, and that has helped us to see a very sharp reduction in aggregate demand. Aggregate demand in 2022 was growing by more than 10% in real terms. Last year, it fell down by 3.8%. the current account deficit, which was 6.2% of GDP in 2022, went down to 2.7% of GDP last year in 2023, and is expected to remain around the figures like that in 2024. So the macroeconomic adjustment is taking place, and I would say that so far fiscal policy has supported monetary policy in the process.
So that, in spite of the projected deterioration of the fiscal stance.
Yeah, the projected deterioration is within the framework of the fiscal rule. Is because we have that deterioration in economic activity allows the fiscal deficit to be a little bit higher. The forecast that we had for the oil prices was to have a lower oil price than last year. Now the things are different. So at the end of the year, we may have a different situation, and it's likely that the government will have to adjust their spending plans in order to comply with the fiscal rule. But under the idea that the government will comply with the fiscal rule,
Okay.
we are confident that we will continue working in the same direction.
Okay, let's hope that, because again, as I was saying, the MB spreads are one of the highest among the, so and
Yeah.
that's usually based on the fiscal situation.
I would say that yes, that is true, and that is true since 2021, when we lost that benefit that we had much lower spreads. They went up, but what is also true is that during the last year and a half, spreads have been coming down. They are still above our peers. That's a problem. That's something that we, of course, don't like. But they are coming down significantly, partly because of the global situation, but also maybe reflecting the credibility that we have in the macroeconomic policy of Colombia. That I think is positive at this point.
Okay, thank you. Deputy Governor Heath, Mexico.
In our case, there's no doubt. We have a complete desynchronization between monetary and fiscal policy. We're slamming on the brakes. We're trying to bring inflation down, and the government's stepping on the accelerator. The programmed deficit for this year is 5% of GDP, and that's kind of the traditional definition. The more extended range is even slightly higher. And this represents a deficit that is 2 times higher than the 15-year average that we've had for the previous 15 years. And it is the highest deficit that we've seen over the last 30 years.
Yes.
The increase in the deficit is huge. And what we expect, and we're already seeing a lot of evidence on that, is a lot of the extra government spending is definitely being front-loading. Spending in more in the first half and the first quarter of the year. And the reason is we have elections in June. And part of the reason is, well, first of all, the government cannot carry out social spending programs in the 2 months prior to elections. So that means that they've been giving everybody who receives a handout twice the amount in the previous 2 months before that. And at the same time, they're really trying to finish all their signature projects and try and do as much as they can. Every single last year of an administration now for the last, I would say, 4 or 5 decades, we've always seen this pattern where the government spends more in the last year, but it's always front-loaded. And then in the second half of the year, once elections are gone, the spending drops dramatically more than anything because they spend everything they had, and second of all because they're leaving and they're packing their bags and their elections are over, and that's it. So we can't really say that this is necessarily a departure from typical calendar year effects in terms of spending. However, it is definitely very important because it's right in the middle when we're really trying to finish our inflation battle, and the government's coming along and increasing spending, I would say, dramatically. This is one of the biggest risks that we are facing right now, and it's especially going to be seen in the first half of this year, because we do expect economic activity to start slowing down and a lot of things to start kicking in the second half of the year, which should be able to help us.
Yeah. Yeah, thank you so much for your frank view about this situation. And yeah, you're right. It's terribly worrisome, especially since more and more there is expectations that global inflation may start picking up again, right? Which is not working in favor of your efforts in trying to reduce inflation in Mexico. Well, Deputy Griffin Jones, I guess for you the question is completely difficult because I don't have that problem or those forecasts of huge deteriorations in fiscal deficits. Not only that, in Chile, the ratio of public sector debt relative to GDP is among the lowest in the region. So just briefly, so because really there is not much there to discuss with you, are you concerned about in any form of any fiscal slippages complementing the pursuit of monetary policy?
Well, formally, the central bank isn't supposed to give opinions on fiscal policy. But basically, we recognize very clearly that, as you say, Liliana, fiscal policy has worked hand in hand with monetary policy in this tough job of lowering inflation, because the fiscal deficit had grown very significantly as a response to COVID, and to that was added, as I mentioned, a very large private pension fund withdrawals, which were authorized through the Congress, and there was this huge boost of aggregate demand. But then in 2022, and particularly in 2023, there was a very sharp reduction in government spending and in the fiscal deficit. And that helped, together with our tight monetary policy, to reduce inflation very much. So we work really hand in hand, and there have been really no issues. There is some very slight increase in government spending, but it is not something that seems of great worry. And as you say, we're very lucky that we have a public debt, foreign public debt to GDP, one of the lowest ratios in Latin America, and of course very low if I look at European countries and the US. So we have this good situation, and therefore we also have very cheap borrowing costs for borrowing abroad. The spreads are, I think, remain the lowest in Latin America because of that. So we're very fortunate in that we have been working hand in hand. It's also an interesting institutional arrangement that the finance minister comes to our board meetings for monetary policy, but he has the right of voice but no vote. So he comes, he presents his point of view, and then he leaves, and we vote, which is, I think, different from, say, Colombia, which I understand the finance minister actually presides the monetary policy board.
Yeah. All right. So you are certainly in a very good position. Jonathan, you want to make an intervention? Please go ahead.
Yeah, that's very interesting because the finance minister also goes to our meetings, and he also has voice but no vote. But we vote first. And once we voted, then we listen to what he has to say.
That's interesting. In our case, we listen to him. He usually speaks first. Then we speak, and he listens to us, and then he leaves, and then we vote.
Yeah. Yeah, but those, I guess, those institutional arrangements play a part, but not completely, as after hearing what is happening in Mexico. So it's a combination of everything. All right, this is great. So now let's move to a more thorny issue, which is economic growth. Because to me, this is quite disappointing in Latin America, right? Leaving aside the pandemic period, Latin America is the region in the developing world with the lowest rate of growth. If you look at the forecast, both for the IMF, for the World Bank global economic prospects, Latin America is always there. For the last 3 or 4 years, always the region with the lowest rates. So let's try to understand the reasons for this result. Let me start with you, Governor Villar. Economic growth has decelerated in the last year and a half, of course, from the very high rate of 2022, right? And the data suggests that it can be mostly explained by a significant decline in investment, which is greatly below the pre-pandemic level. So it's not, it's just a real decrease in investment. What are the key factors explaining this decline in investment, and will it continue to be depressed in the foreseeable future?
Well, I will start by saying that we had a very sharp deceleration of growth. Growth was only 0.6% in 2023, and we expect to have something around 1.1% this year. But it's always important, as you mentioned, to have in mind that in 2021 we grew by almost 11%, and in 2022 by 7.3%. So if you take the level of activity of Colombia and compare to the pre-pandemic level, we had in 2023 a very a level of activity that is above the pre-pandemic trend. So we had a level of activity that was above what we would have had if we had not the pandemic, and we had continued growing as we were growing before 2019. So in that sense, the problem of growth in 2023 and perhaps this year is just a problem of temporary adjustment. What we have for the future is a deeper problem, which is whether we can recover high permanent growth. And in that front, there is something that is concerning. As you mentioned, the problem is that we had a very sharp reduction in investment. During 2023, we had a surprise reduction in growth. The growth was only 0.6% when we were expecting something around 1%, and most other analysts were expecting more than that. But the surprise was not in consumption. In consumption, we saw a reduction as we were expecting and as we thought was required. But the level of investment fell by 25%. It was a very dramatic reduction. Part of that can be explained by the increase in interest rate, of course, but if we compare with other countries, what we see is that cannot be the explanation. There was a very significant reduction, for instance, in civil works, in public investment, and also in private investment in some sectors in which there is a lot of uncertainty about the public policy about them. So what we have is a situation in which macroeconomic policy is working as expected, but we have several sectors in which there is a lot of uncertainty about public policy for the sectorial public policy, and that is reducing investment and may reduce the possibilities of a high permanent growth in the future. Still, we are expecting the growth to be recovered in 2025 above 3%, but of course uncertainty is very important, and we have to to be monitoring what happens with investment this year and the next few years.
Okay, thank you. Let me now turn to Chile and Mexico. These two countries should be definitely growing more. First, Stephanie, Chile has less labor and firm informality than peer countries, stronger indicators of institutional quality, sound external demand for copper and lithium, but growth forecast for 2024 fluctuating between 2 and 2.5%. What is holding growth?
Well, that's a very important issue. I think that personally, and this is not necessarily the view of my colleagues at the central bank, I'm very optimistic in the medium term about Chilean growth because we have, as you pointed out, these resources that are so crucial for the energy, for the green transition. And as Nick Stern, a very important scientist, economist in the issue of climate change, points there's a new economic geography. So those countries that have the raw materials and even the elaborated materials that will be crucial for this green transition will have a big advantage. And we're very lucky, we're blessed in Chile because we have, as you said, copper, we have lithium, and we also have huge potential for green hydrogen, which can also be exported. And so therefore, we're in a very, I think, privileged position if those resources are well used. So I think that in the medium term, I think Chile has a lot of potential. I mean, in general, and also foreign direct investment has been increasing quite a bit recently because I think there is a lot of foreign interest in investing in for example, in lithium and green hydrogen. So I think we had, of course, very low growth. Last year we grew only 0.2%, and now we're projecting for this year between 2 and 3%, which is quite a big jump, although, as you say, it's still modest. And then for the next 2 years after that, we're projecting between 1.5 and 2.5%, which is an improvement from what we had, but I agree with you, is insufficient. So, I mean, I used to be a development economist. So if you look around the rest of the world, what the countries that have grown a lot, whether it's the US or Scandinavian countries or Southeast Asia, China, India, I mean, what do? They save a lot and they invest a lot. Chile has a relatively high investment by Latin American standards, but it's very low compared to these kind of countries. Education is absolutely crucial, and investment, for example, in innovation is very, very important. And again, the rate of investment in innovation is very low in Chile. It's going up a little bit in the last year or so, which is good. But I think all these are big medium-term challenges to increase productivity and to increase growth. And I think one advantage, an important advantage of having controlled inflation, almost there, not quite, almost there, and resolved balance of payment disequilibrium, is that you can then concentrate as a country, all the sectors, public and private, to think about long-term growth and how you can enhance it.
Okay, so maybe in the medium term, things are going to look much better looking forward. Jonathan, so Mexico's benefit from external factors, better than expected growth in the US, and the effects of nearshoring and friendshoring and all the shorings that you can think of. And still market forecast for growth for 2024 don't surpass 2.5%. And this is not only 2024. If you look back, it's kind of Mexico is stuck in that 2.5 range for many years now. So what is holding growth there?
Well, actually, the the surprise here was 2023, which was a complete exception to what you were saying.
Yeah.
If you go back a year ago or towards the very end of 2022, most forecasts, the consensus forecast for growth for 2023 was, if we were lucky, maybe above 1%. And the reason why most people had a relatively low forecast for Mexico was because they were expecting either a recession in the US or definitely a slowdown. The recession never came, the economy never slowed down, and the US did quite well, as you pointed out. And instead of growing just slightly above 1, we grew above 3%. If I just stopped right there, then we would conclude, well, yeah, of course, because the US did well, so our exports did well, and so we grew more than what was expected. However, if you look at the breakdown of GDP on the expenditure side, it tells you a completely different story. The only component of GDP that actually fell in 2023 was exports. So that did not contribute at all, and has actually does not explain the jump from 1 to a little bit over 3. It was definitely the domestic economy. And I would say this is the first time that we have seen in a long time, 20, 25 years, as far as my recollection is, that we've seen the domestic economy respond without the push from export growth. And the interesting part is we had a relatively good and steady household consumption as a result of real wage growth, and also the increase in remittances, and we've had a very steady household consumption. But the surprise factor that just seemed to almost come from nowhere was this huge jump in private investment. Private investment growth had been absent, I would say, basically since 2015. And public investment, even worse. For 13 years in a row, we had negative growth rates on public investment. And then last year, both public and private investment grew near 20%. The reason why, and the only plausible explanation that we have for this huge growth in private investment is definitely nearshoring opportunities. Nevertheless, a lot of people are pointing out a lot of kind of inconsistencies in some of the data. There is definitely certain indicators that show, yes, this must be definitely nearshoring opportunities that they're taking advantage of. But there's other indicators that really don't necessarily show that. Foreign direct investment flows, new investment flows, not a reapplication of profits or reinvestment of profits, which was the largest component. But new investment on foreign direct investment really was very small. However, because private investment grew mostly in the north, which is closer to more of the opportunities that we would think would be related to nearshoring, it does seem that it was a very big push in nearshoring. So the question here is, will these nearshoring investment growth continue? It seemed to have dropped in the fourth quarter of last year. Is that an outlier, or is it a change in the trend? We still don't quite know. There are definitely a lot of nearshoring opportunities there in the pipeline. We should still see, I'd say, growth over the next few years or so, but there's a lot of hurdles that we have to overcome. And probably one of the main hurdles is the possibility that Trump comes back to be president in the U.S. And as you know, he bullies Mexico. He's threatened us with the new tariffs. He's threatened us with a lot of things. Among other, he may want to renegotiate our free trade agreement. So there's a lot of things there that could happen and could go against nearshoring opportunities. But definitely, I'd say that would be the route to go, to make sure that private investment continues to grow. Maybe not at 20%. That would be really great, but at least at a relatively high rate and a steady rate, and then that would definitely help Mexico get back on track to have higher growth rates.
Yeah, very, very interesting comment, especially the last part where you have the external factors that could work in either direction. On the one hand, helping, on the other hand, being a detriment, right? I mean, certainly the next few years will be really important and to watch in terms of what's happening for Mexico, to see whether it finally gets, the promised path, right, of a stronger growth. We have time for one more question, and I want to move to something that, of course, is in everybody's mind, which are the political pressures that countries are facing. And, what are your views on that? So let me start first with Governor Villar. Um, there have been street protests against some of the proposed reforms by the government. And one that stands out is the proposed health reform that was rejected by the Senate last week. For our audience, that reform aimed at increasing the role of the state in the health system by reducing the power of health insurance, all, of course, for the purpose of expanding access to healthcare. How are these political pressures, these and others, and uncertainties weighing on the role of the central bank and in meeting its objectives?
Liliana, it's very difficult for me to talk about the very, very dedicated questions, political questions. But what I would say is that people are becoming used to see a very sound macroeconomic policy, and at the same time, very deep problems in some sectoral policies. The case of the health sector is very difficult. The Congress rejected the proposal of the government, but at the same time, the government intervened two of the largest providers, insurance companies in the health sector, which are the private companies that organize the sector, so that the government is now controlling most of the private sector. Most of the health sector, and there is a lot of uncertainty about what can come later in that front. Also, the president has said that he wants to push for a constitutional reform, and he has mentioned one of the issues to discuss in the constitutional assembly that he wants to create is the objective of the central bank. But what we have seen is that there is a lot of confidence in international investors and also in domestic investors and in the private sector about the institutionality of Colombia. And these debates are taking place, but at the same time, people see that the institutions are working, that there are lots of balances to these proposals, and what we see in practice is that the spread of the risk spread of the Colombian debt is reducing even during these last few weeks. The exchange rate in general is also appreciating. The Colombian peso is appreciating. So there is a disconnect between those discussions about sectoral issues and the macroeconomic discussion, the macroeconomic debate, in which everything is working in the same direction, and I think is working in an adequate direction. And we are obtaining good results in the sense that we are reducing inflation. We are establishing the basis for a renewed growth in the future. We are already starting to reduce interest rates, but at a slow pace and very cautious pace. But that, I think, is receiving a lot of positive valuation from the markets and from investors.
Bottom line, there is, as you're saying, kind of a separation between the political and the economic, and the economic is functioning, the macroeconomy can work well in spite of whatever noise there could be from the political arena. All right.
Yes, it's a very good summary.
So, Deputy Governor Heath, 2024 is, of course, an election year, right? The last 4 elections cycles in Mexico witnessed a large increase in political violence. What are your views on this potential risk as we get closer to the election? Could political violence affect in any way the conduct of macroeconomic policies, including monetary policy?
In the last part there that you said, in the terms of will these political pressures and problems that we have influence our monetary policy decisions? I would say no. Maybe there is an indirect connection there. Maybe because of political pressures, the government is wanting to spend more, and because you have an expansionary fiscal policy, that'll make our monetary policy decisions maybe a little more difficult. Yeah, there are certain obviously connections there. But I would say in general, we are definitely facing increase in violence. We are definitely facing an increase in insecurity, extortions, highway robberies, train robberies, kidnapping, assassination of political candidates. We're seeing a lot of problems on the political side, a lot of violence definitely flaring up. However, I would say that at the end of the day, our decisions are very much in line with where we see inflationary pressures, and we're not really paying that much attention to the political cycle per se in terms of our decisions.
Okay, all right, fair enough. Deputy Griffin-Jones, any thoughts on that? I know that these issues are not as elevated in Chile as in other countries in the region, and that's great news. But any thoughts on that effect or potential linkages between political stresses and the role of the central bank?
Well, I think that in the time when we're trying to reform the constitution, as you know, when there was this social events, the so-called social explosion, estallido social, the way the politicians channeled the protests was to say we're going to have a new constitution. And so then there was a lot of uncertainty. There was first a more left-leaning constitution, which was rejected. And then there was a more very right-leaning constitution, which was also rejected. And then the politicians deciding, particularly the president, that there would be no more constitutional discussions. And that has actually reduced the uncertainty quite importantly. We have at the central bank an index where we measure uncertainty, and that has actually come down quite a lot. So, I mean, the issues were not resolved, but they came off the political agenda. So that was, I think, very good. I mean, the issues are more within the institutional channels. I mean, can the government get through the reforms it wants to do, for example, of the pension system or tax reform through the Congress, because it doesn't have a majority. So those are issues, but I would say they are broadly within institutional channels, and they shouldn't affect really either domestic or foreign investment. I think one final issue that perhaps I should have mentioned before, I mentioned these resources that we have in the country, like copper and lithium and so on. I think an interesting issue is whether the country can do sufficient, if you like, moving up the value chain, which perhaps we didn't do with copper, for example, but can we do it more now with copper and especially with lithium? That's a little bit a dream. And can the politicians and the public and the private sector get it together and work with foreign investment and local investment to achieve that? I think that is I think a big challenge. Perhaps if the country can unite around that kind of objective and stop maybe quarreling about small issues, that would be great.
Thank you so much, Stephanie. Okay, great. So just to finalize, let me give each of you 1 minute to for closing remarks to each one to just say whatever you think I didn't ask or you want to share with us that our audience could benefit from. So, Leonardo, you would like to go first?
Okay, well, what I would say is that we have had a very strong, a very deep tightening of monetary policy during 2 years and a half. We increased our interest rates by 11.5 percentage points. And we are finally starting to reduce those interest rates very cautiously. We have reduced them by 1 percentage point, but only as far as we can in order to achieve the inflation target by mid 2025. I think this process of adjustment has been very difficult. It is affecting growth in the short run, but it's very important that we have been able to do it, because in the long run, having inflation around the target will be key to recover long-term growth in line with the potential growth of the Colombian economy, which may be much better than it has been in the last a few years. So I think the adjustment is working well in Colombia, and the autonomy of the central bank has worked also well within that framework that we have in the country.
Thank you. Stephanie?
Well, I think that also I agree very much with Leonardo that it's very important to defeat inflation because it provides us a basis for sustained growth, but also because inflation, I think, hurts particularly poorer people and more vulnerable people who have less mechanisms of defense against inflation. So it's a good thing that we've managed to lower inflation significantly, although we would prefer, we're looking forward to it actually reaching the target, which is 3%, and now focusing on the perspectives of growth, which I think will be easier now that these big macroeconomic disequilibria have been resolved. I think the issue perhaps that you raised earlier on, Liana, about differential of interest rates is an important one because it has contributed to a depreciation of our local currency, and the measure, to the extent that the Fed lowers interest rates and also our neighbors lower interest rates, this will allow us. This will imply that the Chilean currency will also strengthen.
Thank you. Thank you. Jonathan, you have the final word.
I think one thing that where Mexico has stood out is that we keep getting a lot of criticism and comments of that. We have one of the highest restrictive monetary stands in the region. But nobody mentions the context, is that we have much less financial deepening and much less credit penetration. And as a result, the effectiveness of our monetary policy isn't as great as it is in other countries. And that means that we need to have a stance that is higher for longer to hopefully have the same results as maybe other countries do. I think that's a very important consideration. And the second is that we have a lot of structural constraints and idiosyncratic factors that make it very difficult to bring our inflation down to 3% and keep it at 3%. A lot of it is in terms of, for example, these huge problems, as I already mentioned, that we have in terms of security. Transportation costs have increased dramatically because of all the lack of security in terms of trying to distribute goods from one point to another. We have probably a much less competitive economy in a lot of relevant sectors, which mean that you have a lot more stronger firms that are price makers than maybe they would be if we had a more competitive economy, especially our financial system. which is very, very concentrated in a very few number of banks, which are definitely have what to say on in terms of the market. So I think these are additional considerations that have to be considered when we talk about and try to understand the Mexican monetary policy path that we're going to be following for the rest of this year and next year.
Thank you so much. Well, I think we have had an incredibly interesting conversation. I really have to thank all of you for being with us today. I hope we can repeat this soon. Certainly, all of you have given issues, themes that deserve to be followed up. Well, this has been the first of the Center for Global Development event pre the spring meetings of the IMF and the World Bank. We'll continue with more events coming up on next week. And well, with that, I'd like to say goodbye to all of you. Thank you so much to all of our audience. I believe there is a little video showing what is the other events that CGD will be having in the next week. Thank you, Stephanie, Leonardo, Jonathan. It was great having you all. Until next time.
Thank you.
Thank you.
Thank you.
Thank you, Liliana.